California's home insurance market is changing fast, and it's now affecting more than just insurers. It's impacting homeowners, buyers, and investors across the state. In today's video, 10 California cities where homes are quietly becoming uninsurable. Beware of buying here. We identified some cities flagging serious home insurance concern across California and why you should buy with caution in those cities. In many high-risk areas, homeowners are seeing policy non-renewals, rising premiums, and stricter coverage rules. Some are even being pushed onto the California FAIR Plan, which often costs more and covers less. For buyers, this is a major issue. Insurance is now a key factor in loan approval, affordability, and future resale value. If you want an in-depth knowledge on the entire U.S. housing market, hit that like button, subscribe to the Globe Realty, and let's get into this one. Number 10. Riverside, California. Riverside may not have the same luxury home image as some California coastal markets, but that's exactly what makes its insurance story worth watching. The typical Riverside home is now worth about $648,400, and Zillow shows that value is actually down 0.5% over the past year. Homes are still moving relatively quickly, with a median of about 18 days to pending. But here's the question: what happens when a market that already isn't appreciating much has to absorb rapidly rising insurance costs? Riverside's wildfire exposure is very real. The city's own wildfire mitigation plan identifies roughly 14% of the city's land area as wildland-urban interface, with high-risk areas including Mount Rubidoux, Lake Hills, Mockingbird Canyon, Sycamore Canyon, Box Springs Mountain, and La Sierra Norco Hills. And the geography makes this particularly concerning. Riverside has hot, arid summers, very low humidity at times, dry vegetation, and Santa Ana winds that can rapidly push flames across the landscape. City officials explicitly warn that these conditions can produce fast-moving, difficult-to-control wildfires. We've also seen the risk play out on the ground. In January 2026, 3 vegetation fires in the Santa Ana River bottom burned more than 6 acres, requiring multiple fire engines, CAL FIRE assistance, and additional state resources. And here's where the insurance story gets uncomfortable. Riverside County was already subject to a state-mandated 1-year protection against insurance cancellations and non-renewals following the 2022 Fairview fire. That doesn't mean every Riverside homeowner is being dropped, but it does show that insurers and regulators have already had to respond to wildfire-related insurance pressure here. So if you're buying in Riverside, don't just ask about the purchase price. Ask your insurer about the exact address before you fall in love with the house. Because in California today, you don't necessarily have to live in the mountains to pay the mountain insurance bill. Number 9. San Bernardino, California. If you're looking at San Bernardino because the roughly $496,000 typical home value looks more attainable than many California markets, there's another number you need to look at: the cost of insuring that home. As of June 2026, Zillow puts the typical home value at $496,100, up about 1.2% from a year earlier, with homes going pending in roughly 18 days. So this isn't a market where buyers have simply disappeared. The demand is still there. But here's where things get complicated. San Bernardino sits directly beneath the San Bernardino Mountains, and that geography creates a serious wildfire exposure. In 2024, the line fire burned nearly 44,000 acres, fueled by dry grass, chaparral, and timber across steep, rugged terrain. The fire also triggered evacuation warnings and orders in mountain communities and areas extending toward the foothills. And this isn't just an old insurance story. In September 2024, California's insurance commissioner imposed a 1-year moratorium protecting roughly 170,000 policies in San Bernardino County from wildfire-related cancellations and non-renewals because of the line fire. Think about what that tells you. If the state has to temporarily stop insurers from dropping policies after a major fire, insurance availability has become a real housing market issue. And San Bernardino's risk isn't evenly distributed. The state's updated fire hazard severity zone system now distinguishes moderate, high, and very high-risk areas, meaning your exact zip code, and sometimes your exact neighborhood, can matter enormously. That's where buyers need to be careful. A home several miles away from the foothills can have a completely different insurance profile from one closer to brush, steep terrain, and the mountain interface. California's own Department of Insurance acknowledges that residential insurance is becoming harder to find in areas insurers consider to have above-average wildfire risk. So before you look at that $496,000 price tag and think you've found a bargain, get an insurance quote for the actual address. Because in San Bernardino, two homes can be only a few miles apart, and one can be dramatically harder to insure. Number 8. San Diego, California. San Diego is where California's insurance problem starts getting much harder to dismiss. This is one of the country's most desirable housing markets, but the typical San Diego home is now worth about $1 million, according to Zillow's June 2026 data. And that's actually down 1.7% over the past year. The median sale price was about $950,000, with homes going pending in roughly 18 days. So here's the question. If you're already paying around $1 million for a home, how much more can you afford when insurance becomes another major housing expense? San Diego's wildfire history isn't new. The devastating fires of 2003 and 2007 showed just how quickly flames can move through this region. But what's changed is the financial exposure. San Diego isn't simply a collection of houses surrounded by open land. It has expensive neighborhoods built around canyons, hillsides, and pockets of vegetation, creating what insurers increasingly view as concentrated wildfire risk. And the numbers are getting uncomfortable. A 2025 analysis found that more than 17% of homes in San Diego County face severe or extreme wildfire risk, representing more than $155 billion in property value. The estimated insurance premium for a typical county home was about $3,140. Then there's the rate pressure. Bankrate's analysis found California had the fastest-growing home insurance premiums between 2023 and 2025, while San Diego saw an estimated 27% year-over-year increase in average premiums in that analysis. And this is where canyon geography matters. You don't need to live in a forest to face wildfire exposure. A home bordering a canyon can be surrounded by vegetation that gives fire and embers a pathway toward developed neighborhoods. Add Santa Ana winds, prolonged dry conditions, high construction costs, and expensive real estate, and insurers have a much bigger potential loss sitting behind every policy. That's the uncomfortable part for buyers. San Diego can still be an incredible place to own a home, but the purchase price is no longer the only number you need to calculate. Before you make an offer, check the wildfire exposure. Get an insurance quote for the exact address, and find out whether the coverage can actually be renewed. Because $1 million California home isn't much of a bargain if protecting it becomes a financial struggle. Number 7. Ventura, California. Ventura is a good example of why California's insurance problem cannot be judged simply by looking at whether a home is near a forest. The typical Ventura home is now worth about $897,000, up just 0.3% over the past year. The median sale price was around $882,000, and homes were going pending in roughly 16 days as of June 2026. So the housing market is still moving, but here's the uncomfortable question. What happens when the cost of protecting an $897,000 home starts rising faster than the value of the home itself? Ventura has a combination that insurers have increasingly had to pay attention to: coastal development, foothills, dry vegetation, and wildfire exposure. You don't have to live deep in the mountains to be affected. Homes can be close to developed neighborhoods and still sit within areas where wildfire can move quickly through brush and open terrain. We saw a very real example of the insurance pressure following the Gifford fire in December 2025. In January 2026, California Insurance Commissioner Ricardo Lara ordered insurers to preserve residential coverage for more than 147,000 policyholders across Ventura, Santa Barbara, San Luis Obispo, and Kern counties. The one-year moratorium covered people within or adjoining 29 zip codes affected by the fire and prevented cancellations and non-renewals during that period. Think about what that means. The government didn't step in because insurance was working perfectly. It stepped in because wildfire exposure had become serious enough that thousands of homeowners faced the possibility of losing coverage. And Ventura has another complication. Coastal exposure doesn't cancel out wildfire exposure. A property can be near the ocean and still face wildfire risk from the foothills, dry vegetation, and wind-driven fire. Then add expensive California construction, rising replacement costs, and nearly $900,000 in typical home value, and insurers have a lot of money at risk when something goes wrong. For buyers, this means the question shouldn't simply be, can I afford this house? You should also ask, can I afford to insure this exact house 5 years from now? Because in Ventura, the beautiful coastal lifestyle may come with a risk many buyers don't see until the insurance quote arrives. Number 6. Redding, California. Redding is where California's insurance problem becomes especially uncomfortable for buyers looking for affordability. The typical Redding home is worth about $394,750, according to Zillow's June 2026 data, and that value has actually fallen 1% over the past year. The median sale price was about $400,400, with homes going pending in roughly 18 days. On the surface, that looks attractive. Compared with California's million-dollar housing markets, Redding can seem like a place where your money actually goes somewhere. But here's the question. What if the lower purchase price comes with a much bigger insurance problem? Redding's wildfire history changed dramatically with the 2018 Carr Fire, which burned through the Redding area and destroyed thousands of structures. That disaster demonstrated something insurers already understand. In Northern California, wildfire can move from surrounding forests and brush into developed communities with frightening speed. And the underlying conditions haven't gone away. Redding sits in a region characterized by hot, dry summers, heavy vegetation, rugged terrain, and strong winds. Those conditions create exactly the combination insurers worry about when calculating wildfire exposure. The problem is that insurance doesn't price a home based solely on its sticker price. It also considers the potential cost of rebuilding it after a catastrophe, and construction costs in California have become a major part of the insurance equation. There is another issue buyers need to understand. California's FAIR Plan is designed as a last resort option for homeowners who cannot find coverage in the traditional market. But the Department of Insurance warns that FAIR Plan residential policies provide limited fire and smoke coverage, meaning homeowners may need separate coverage for risks such as water damage and liability. And California is actively trying to reverse the growth of the FAIR Plan by requiring insurers to write more policies in wildfire-distressed areas. The state says this is part of its broader, sustainable insurance strategy. So Redding presents a very interesting trade-off. You can get a California home for around $395,000, but that doesn't guarantee affordable homeownership. Before buying, get the insurance quote for the exact property, check its wildfire exposure, and find out what coverage is actually available. Because Redding can give you the California home price many buyers are looking for, but the insurance bill may remind you why the house is cheaper. If you find this video valuable at this point, hit the like button, subscribe to the channel, and turn on the notification bell. Share the video to as many people as we continue. Number 5. Napa, California. Napa is famous for vineyards, luxury homes, and one of California's most desirable lifestyles. But behind that image is an insurance problem that has been building for years. The typical Napa home is now worth about $876,600, according to Zillow's June 2026 data. But that value has fallen 3.1% over the past year. The median sale price was about $892,840, and homes are taking around 32 days to go pending. Now ask yourself, if home values are softening, but the cost of insuring and rebuilding those homes continues to rise, what happens to the real cost of ownership? Napa's wildfire history is a major reason insurers are paying attention. In October 2017, the Atlas Fire burned more than 51,600 acres across Napa and Solano counties, destroying 783 structures and damaging another 120. CAL FIRE's records show that the same fire started near Atlas Peak, right in the terrain surrounding Napa's high-risk hillside communities. And that wasn't an isolated event. Napa and the surrounding wine country have experienced repeated major fires, including the 2017 Nuns and Atlas fires and the 2020 Glass Fire. That history matters because insurers don't just look at what happened last year. They look at the pattern of losses and the likelihood of another expensive claim. Here's what makes Napa particularly difficult. The risk isn't evenly distributed. A home in a relatively developed part of Napa can have a very different insurance profile from a property surrounded by vegetation on a hillside or in a rural interface. And those expensive properties can be particularly challenging to insure because the replacement cost may be much higher than the home's market value. Think about a custom Napa property with specialized materials, extensive landscaping, outbuildings, long driveways, and difficult hillside access. If a wildfire destroys it, rebuilding isn't simply a matter of putting another house on the same lot. That's where buyers need to look beyond the listing price. A $900,000 Napa home doesn't necessarily have a $900,000 replacement cost. So before you buy that beautiful wine country property, get the insurance quote, check the property's wildfire exposure, and understand exactly what the policy covers. Because in Napa, the most expensive surprise may not come from the price of the house. It could come after you own it. Number 4. Santa Rosa, California. Santa Rosa is where the California insurance story becomes much harder to dismiss as a problem affecting only remote mountain communities. The typical Santa Rosa home is now worth about $720,750, according to Zillow's June 2026 data. But that value is down 1.5% from a year earlier. Homes are still moving relatively quickly, going pending in about 15 days, while the median sale price is around $748,350. So here's the question. What happens when home values soften, but the cost and difficulty of insuring those homes doesn't go away? Santa Rosa learned the hard way during the 2017 Tubbs Fire. The fire burned approximately 36,807 acres across Napa and Sonoma counties and destroyed 5,636 structures, with 317 additional structures damaged. And the important point is where that destruction occurred. This wasn't simply a remote forest fire that stayed away from civilization. The fire reached developed residential areas, destroying entire neighborhoods and permanently changing how homeowners, insurers, and local officials think about wildfire exposure. That history still matters today. Santa Rosa has neighborhoods bordering open space, vegetation, and wildland-urban interface areas. And California's insurance system now explicitly recognizes how difficult coverage has become in wildfire-exposed communities. State law allows insurers to be temporarily blocked from canceling or non-renewing residential policies in zip codes within or adjacent to declared wildfire perimeters. But don't misunderstand that protection. A temporary moratorium is not the same thing as a healthy insurance market. California's Department of Insurance is still trying to reduce dependence on the FAIR Plan and expand private coverage in higher-risk areas. In fact, the state announced in 2026 that it was pursuing reforms to make the FAIR Plan more comprehensive and improve its ability to serve homeowners while they transition back to the regular insurance market. That's the uncomfortable reality for Santa Rosa buyers. The city can rebuild homes after a catastrophic wildfire, but rebuilding the insurance market is a completely different challenge. So if you're considering buying here, don't stop at the listing price. Check the property's wildfire risk, ask what insurers will actually cover the address, and find out what happens if your policy isn't renewed. Because a house can be beautifully rebuilt after a wildfire and still leave its next owner wondering whether they can afford to insure it. Number 3. Paradise, California. Paradise may be the clearest example of what happens when wildfire risk becomes a real estate and insurance problem at the same time. Today, the typical Paradise home is worth about $337,600, according to Zillow's June 2026 data, and that value has actually fallen 2.8% over the past year. Zillow also shows a median list price of about $467,850, which tells you there can be a significant difference between asking prices and the broader value of the housing stock. But to understand Paradise, you have to go back to November 2018. The Camp Fire burned 153,336 acres and destroyed 18,804 structures, according to CAL FIRE. It also claimed 85 civilian lives. The scale of the destruction permanently changed this community and turned Paradise into one of America's most closely watched wildfire rebuilding stories. Now here's where the story gets particularly interesting. Paradise isn't simply rebuilding homes, it's trying to rebuild a community that insurers will actually want to cover. California's Department of Insurance says Paradise became the first municipality in the nation to adopt the IBHS Wildfire Prepared Home Standard as its rebuilding benchmark. That standard focuses on things like roof protection, ember resistance, and defensible space, basically making homes harder for wildfire to destroy in the first place. And there is evidence that stronger construction can make a difference. California officials cite research showing that nearly 40% of Paradise homes built after 1997 survived the Camp Fire, compared with only 11% of homes built before 1997. That's a remarkable difference. But here's the uncomfortable part. A rebuilt house isn't automatically an easily insured house. Buyers still have to consider wildfire exposure, defensible space, construction standards, insurance availability, and whether conventional coverage is actually available for the specific property. Paradise is essentially conducting a massive experiment. Can better-built homes convince insurers to come back? And that's why buyers shouldn't look at a roughly $338,000 home and assume they've found a cheap California bargain. The real question is much bigger. Can you afford the house, and can you keep it insured? Number 2. Los Angeles, California. Los Angeles is where the California insurance crisis stops looking like a problem confined to mountain towns and starts looking like a problem for one of the country's biggest housing markets. The typical Los Angeles home is now worth about $949,480, according to Zillow's June 2026 data, down 0.7% over the past year. The median sale price was about $1.03 million, and homes were going pending in roughly 26 days. There were also more than 8,200 homes listed for sale at the end of June. But January 2025 changed the insurance conversation dramatically. The Palisades and Eaton fires destroyed thousands of structures across Los Angeles County. The Eaton fire alone had destroyed 9,418 structures by January 23, 2025, according to Los Angeles County's official reporting, and the insurance response was extraordinary. California imposed a mandatory one-year moratorium on wildfire-related cancellations and non-renewals in zip codes within or adjacent to the Palisades, Eaton, and several other affected fire perimeters. Think about that for a moment. When the state has to step in and temporarily prevent insurers from dropping homeowners after catastrophic fires, we're no longer talking about a minor increase in premiums. We're talking about the availability of insurance itself. And Los Angeles has another problem. The properties at greatest risk can also be among the most expensive to rebuild. That's where the California FAIR Plan has become increasingly important. It is designed as a last resort source of coverage when homeowners can't obtain insurance through the regular market. But FAIR Plan coverage is not simply a cheaper substitute for traditional homeowners insurance. Homeowners may need additional coverage for risks such as liability and water damage. Now here's the surprising part. California's Department of Insurance and the National Association of Insurance Commissioners found that rebuilding homes in the Palisades and Eaton fire areas to stronger wildfire resilience standards could reduce projected wildfire losses by roughly 1/3 on average. So the real question isn't simply, does Los Angeles have a wildfire problem? We already know the answer. The bigger question is, can Los Angeles rebuild in a way that makes these homes safer and attractive to insurers again? Because when you're buying $1 million California home, the mortgage isn't the only financial risk you need to calculate. You also need to know whether you can keep it insured. Number 1. Malibu, California. Malibu is where the insurance problem becomes especially difficult to ignore because the homes themselves are so valuable. Zillow's latest June 2026 data puts the typical Malibu home value at about $3.21 million, essentially unchanged from a year earlier. The median list price is even higher, at roughly $3.57 million. And that raises a very simple question. What happens when you combine a multi-million-dollar home with one of California's most persistent wildfire environments? Malibu has been dealing with this risk for years. The 2018 Woolsey fire destroyed hundreds of homes across Malibu and surrounding communities. Then came the Franklin fire in December 24, followed by the January 2025 Palisades fire, which destroyed more than 700 homes in Malibu, according to local reporting. The insurance problem becomes even more serious when you consider the cost of rebuilding. A multi-million-dollar Malibu property isn't necessarily a multi-million-dollar insurance claim. Coastal engineering, steep terrain, specialized construction, difficult access, debris removal, and increasingly expensive labor can all push reconstruction costs substantially higher. And we're seeing the consequences on the ground. More than a year after the 2025 fires, Malibu's rebuilding process remained painfully slow. Reporting found that only 22 permits had been approved for more than 600 destroyed homes, with insurance shortfalls, high construction costs, environmental restrictions, and infrastructure problems all contributing to delays. That's the part prospective buyers need to understand. The insurance question isn't simply, will an insurer cover this house today? It's also, what happens when the policy comes up for renewal? Because California's insurance market is changing, and a property that can secure coverage today isn't guaranteed to have the same options several years from now. Malibu also illustrates something uncomfortable about high-end real estate. The more expensive the property, the more expensive the insurer's potential loss. So when insurers evaluate a $3 million+ home surrounded by steep terrain, vegetation, and wildfire exposure, they're not just calculating the chance of a fire, they're calculating the potential size of the check. And that's the real warning for Malibu buyers. The home doesn't have to become literally impossible to insure. It only has to become too expensive for enough insurers to want the risk. Before buying here, get the insurance quote for the exact property, understand the coverage limits, and investigate the property's wildfire exposure. Because in Malibu, the biggest cost of owning the dream home may not be the mortgage, it may be keeping the dream insured. And there you have it. 10 California cities where homes are quietly becoming uninsurable. Beware of buying here. The bigger takeaway is that California's insurance crisis isn't just about wildfires anymore. It's about the true long-term cost of owning a home. And remember, risk varies widely by neighborhood and property, so always check insurance availability before you buy. Now I want to hear from you. Would rising insurance costs change your mind about buying in California? Drop your thoughts in the comments. If you found this video helpful, hit that like button, subscribe to the Globe Realty, turn on notifications, and I'll see you in the next one.